Hello and welcome, everybody. We certainly appreciate all the questions that you all submit from time to time. Today, we have a number of questions relating all the way back to Market Vision 2025. We had a number of questions come in. Didn't really have time to go over all those questions then, but we'll take some time today to try to answer some of those questions. Also, anyone who has submitted questions into support, we'll try to take a look at those as well. So we're going to go ahead and get started. Matt Townsend is with me today. And of course, my son Tyler is recording this event for everybody. So Matt, why don't you go ahead and kick it off? Let me know what questions you got, and I'll see if I can get some answers.
Awesome, yeah. First one we got is from Larry. He's just wondering about your process of analysis. So he said he started a Zacks subscription so far, and he thinks it's better than Seeking Alpha. But his question is, how do you weigh the charts versus fundamentals, and what Zacks shows? Do you start with the fundamentals or the chart, essentially?
Yeah, that's a really good question. I mean, I follow both fundamentals and technicals. I don't really know that there's one that beats the other one. Normally pulling the trigger, I always pull the trigger based on technicals, not fundamentals. But in terms of setting up like our strong earnings chart list, I'm much more interested in, say, fundamentals, because I want to make sure I've got companies that are performing at or above, our expectations. So we want companies that are beating Wall Street estimates as to both revenues and earnings per share, that have liquidity, and it also look, technically like they are set up and poised to go higher, either based on their own chart or based on their industry groups. So those are the things that get charts in, or get stocks into our strong earnings chart list. And then those are usually stocks that we point out to either trade or include in our portfolios. They tend to come from that strong earnings chart list. So I'd say it's a combination of both.
Cool. Next we got a question from Brian and Scott, and I think this one might be a little dated. I think this one was before Market Vision, but it's a sector ETF one. So we'll start out with if you look at a monthly chart, almost all the sectors are showing bullish engulfing candles, with the exception of those in downtrends, um, which all are showing either dark cloud cover, or shooting stars. What's your take on that?
Well, first thing you have to understand about candlesticks are, you're looking at a visual. I tend to use candlesticks almost exclusively, not exclusively, but almost exclusively on the daily charts. Because on the daily charts, you have an open and a close, one open and one close every day. The market physically will open and will physically close on a one-day candle. When you have a monthly candle, you're taking the open as being the first open in the month and the last close of the month. You got a lot of opens and closes during the month that don't get reflected on a monthly chart. So, I like to look at the candles because they explain to me a lot of what's going on in terms of market makers and what market makers are up to. In other words, sometimes you might have a day where you gap up above resistance, and then can't seem to go any further, and end up coming back down. A lot of times that's an opportunity for market makers to get out of a stock, or to maybe jump in, or encourage. They're kind of like leading retail traders. And so you don't get that same kind of a feel from a weekly or a monthly chart. And I'm not saying that they're not useful. I just don't really follow them. And I certainly, because I'm more of a short-term momentum trader, trying to wait on a candlestick to form on the monthly chart. You might have on the 26th of the month, you might have a monthly chart that looks very bullish, like it's a reversing bullish engulfing candle. And then by the time the 31st hits, it's already, it's come back down or whatever, and it's no longer a bullish looking candle. So you just have to understand that, monthly charts are going to take 30 days, not trading days, but 30 calendar days before they're going to print and be final. And in the meantime, I don't know, I think that you miss out on a lot as a short-term trader. Now, somebody who does, very, very infrequent trading might find those candles to be a little bit more useful, but they're still not really telling you what the market makers are doing by looking at a monthly chart. So I would just say, for me, there's much more focus on candlesticks if it's a short-term chart. Usually a daily chart makes the most sense for me.
I think that makes sense. Next, it's still in the same brand, sector ETF. So we have, I believe Scott asked, I'm looking to enter some sector ETFs, and this will be after some tax harvesting, I'm sure. Um, is there any certain ones that you're looking to rotate into at this current time? I know we got our ECF portfolio coming up soon, so I'm sure you're going to look into that a little more.
Yeah, I mean, we could look at like XLK versus S&P 500 on a monthly basis. And let me just get rid of candlesticks. If you look back, the secular bull market that we're in actually started in April of 2013, down around here. And you can see that throughout the secular bull market, technology, if you want to outperform the S&P 500, you really needed to have been in technology and consumer discretionary. We'll pull that one up. You can see that one. Here's 2013. So it tends to outperform, not as much as technology, but does tend to outperform. And same goes for the communication services area. These are the three most aggressive areas. So if you're in a secular bull market, these are the three that I'm really going to be looking at the closest in terms of trying to outperform the S&P. Now, if you use all the other sectors, that's fine, but you're going to diversify and you're going to start to move toward the S&P 500 if you do that. Now, clearly the downtrend of getting into some of these aggressive ETFs like the XLK or the XLY and the XLC is when you go through periods where growth is not rewarded, or sometimes it hurts, especially if you're going into a recession or if you're going into an inflationary environment. Those types of environments would generally produce um, results below the S&P 500 when you're in the more aggressive areas. So it just depends. I believe we're still in a secular bull market that's likely to go on for another 8 to 10 years. And so I think if I was just trying to build a long-term strategy, I would want to be focusing on the XLK, XLC, and XLY. XLF, XLI tend to go up about with the S&P 500 over time. So you have periods when you might see financials outperform, other times when they tend to underperform. Let me see if I can get that chart to come up. Here we go. So here's since 2013. Do you see what's going on with financials? You don't really get a lot of outperformance. You'll get some underperformance. You'll get some outperformance. Usually what I can tell you is that the fourth quarter tends to be very kind to financials. Same goes with industrial, same type. So here's 2013. We saw a little relative strength and weakness and strength. Now weakness again. But if you look at where we are now and where we were a decade ago, if you were in the XLI, you're basically performing along with the S&P 500. So hopefully this kind of shows. And if you look at something like utilities, which is a defensive group, and then you can see from 2013 how you tend to underperform if you stick with utilities just long term, for the long term. So trying to get all of these different moves to the upside in these various sectors is pretty difficult to do. So I'm talking more from a big picture outlook, but to me, it just seems to make more sense if you're talking about a long-term strategy to stick more with like the XLK, the XLY, XLC, know what their weightings are. Like the XLK technology is 32% of the S&P 500. Technology stocks are. Now that doesn't mean the XLK is going to, perfectly represent that 32%, but by and large, that's going to be one of the biggest indicators. So in other words, if I had a portfolio, I would want to at least start with the XLK at 32%. And personally, I'd want to be more heavily involved in the XLK, maybe 40 or 50%, because that's where historically during secular bull markets, you're going to get that kind of outperformance. So anyhow, hopefully from a big picture perspective, that helps some.
Absolutely. Moving on, we got a question from Kai, or actually multiple. So since the SPY's price or sorry, since the PPO reset of the SPY on December 3rd, 2021, there should be no negative divergent. Is this right? And then how do you expect the price change of the QQQ or SPY to happen over the next month?
So that date was 2021 or 2024?
I think you said 2021.
2021. I mean, I wouldn't be looking back for resets that far back. I
Yeah,
don't know if that's a daily, monthly, weekly chart. I don't know if I didn't
it
hear.
could be. I think that it could be monthly, but I don't think they specified.
All right, let's go back and just take a look at the monthly and see. Okay, so there's the reset there. There's another reset here. Yeah, I mean, anytime I get back to about the 50 period moving average, or if the PPO is getting close to the zero line or touches the zero line, as far as I'm concerned, that's where momentum for that period. So if we're looking at monthly, we're talking about monthly momentum. That's when the monthly momentum to me is back down to zero and I start all over again. It's what I call reset. So on a monthly chart, when you get back down to the 50 month, then yes, I start over again. So right now, if you looked at the monthly PPO and saw that it was at 10, and you looked back in 2021 and saw it was at 12, you would say, oh, we've got higher prices and we've got a lower PPO. That's a negative divergence. I would argue against that simply because we went back down to the 50 period test. We got down very close to the zero line. And now as prices are going up again, the momentum is moving to the upside again. So I feel like momentum is supporting this move to the upside, not a hindrance. So yes, I guess my answer to your question is that I follow the reset principle. So on a monthly chart, when that monthly PPO gets to zero or close to zero, to me, that's a reset. Same goes with a weekly PPO or a daily PPO. When you get down to those zero line tests, no matter what period you're looking at, that's when during that period, I feel like momentum has reset.
And then, so what do you have any, or so do you expect any price changes from the QQQ or SPY over the next month or so?
That's so hard to call. Tell me what the Fed's going to do. Tell me how the inflation reports are going to come out. Um, I trying to call the market month to month. I mean, I think we've done a really good job at earnings beats. When you step back and you look at a long-term perspective, knowing whether the trend is moving up or down, or if there are some really big warning signs that are telling us it could reverse. I think that's our strength in terms of calling the market. I don't know anybody who is really accurate about calling the stock market this month or this week versus the following week or month. I mean, I'm of the mindset the stock market's going higher, but I also recognize that we're in a period where we could see a lot of choppiness. I think the daily chart, you could see a lot of weakness and make the daily chart look really bearish, and then you pull it out and put it on a monthly chart, and it really doesn't look that bearish at all. So for instance, if I was pulling up the spider right now and I'm looking at the daily chart, I see the 20-day getting ready. Actually, it just went below the 50-day, so literally just got a death cross, which is a bearish development on this chart. We just broke down to the lowest level we've seen in over 2 months on a closing basis. So I see that on a daily chart, and I'm like, yeah, we could see some more weakness on the daily chart. But when you go to say a monthly chart, during a secular bull market, it's very rare to get anything below a 20-month test. Well, right now, 20-month test on the S&P 500 on the spider would be at 518, and currently we're trading at 580. So, I mean, to me, that's like the worst case scenario. I'm not saying we're going down there. I mean, you can see we've gone now about 15 months without testing that 20-week moving average, but we do test it from time to time. So I think the market's going higher, but I still have to be aware of the fact that to the downside, we've got risk down, maybe another, what would that be, $60, another 10%, a little over 10% from where we are right now. So if I pull up the S&P 500, that 20-month moving average would be 52.42. That's about 600 points, 585 points down to that level, which would be right about 10 percentage points further. Now, to me, that's the worst it could be. Well, obviously it could be worse, but that's in my line of thinking, in my bullish perspective. I think there is downside potential to that level. Not saying we're going there, but I'm not going to be fretting if the S&P drops another 100 or 200 points. I'm not going to change. Every time the market goes down, I'm not going to rechange my forecast. And when every time it goes up, I'm not going to change it again. So I think it's hard to call what the market's going to do in January. Again, without the news, I think there's room for the market to fall further. I also think we could be hitting some support areas where we get a big push to the upside. I would just say this, when I'm not as confident about the short-term direction, which is where I sit right now, I tend to stay with ETFs as opposed to individual stocks. And I tend to stay away from leveraged ETFs. I try to just stick with the mundane, boring approach. And that way, if the market does pull back 10%, I can pull back 10% in my portfolio and still, I mean, I don't like to do it, but it's not going to kill me. I don't know really how else to explain it, but again, I just think short term is very difficult to make those kinds of calls.
So we got some more questions from Ken. I think he's got two on this one. You actually answered one of them in that last little bit. Very cool. So would using PPO in combination of PVO offer any clues?
Good question. I have a limited number of indicators that I use. I'd have to go back and probably study the PVO more. I think that's the price volume oscillator.
Volume.
Yeah. So I would, I mean, I really don't have the answer because I haven't used the PVO. Haven't really looked to try to figure out how it would, differ and so forth. So I'm probably not in a position really to give you a good answer there. I mean, the only thing I would say is whatever indicators you use, just make sure you understand not only how they work, but also their limitations.
And this might also be another limitation thing with stock charts. Also from Ken, on your chart style, is it possible to click a full quote box, like so earnings, dates, and dividends would show? I don't think that stock charts
That's
has that ability.
Yeah, that's a personal question. Adding the full quotes, you go down here at the bottom down here, and you'll see this little box. I'll zero in here. But you see this little box, full quotes, which is next to the volume, that separate volume if you come across here. It's all under chart attributes. But if I click that, first of all, I'll go ahead and click this, and you'll see it, it gives you a lot more information. I mean, I don't really need that information. All of this, the high, open, high, low, close, is all part of my regular chart, which I can show you in just a second. Ask, bid, last, and optionable really doesn't apply to me. Market cap, I generally have a pretty good sense of market cap, so that doesn't really help me. I'm not a dividend investor. Scooter might be helpful to have on here. I could care less about the PE. A lot of folks look at that. I don't. So those are things that really don't appeal to me. And really, by putting it on this chart, it's taking up real estate here where I could have my charts or some other indicators. It's squeezing everything else. So that's why I don't include it. If I go back to this chart here, let's zero back in. So let's go over here. So you can kind of get an idea of the real estate that's showing on your screen with that full quote. If I take it off, I just feel like I have a little bit more. And if you look up here at the top, this is your open, high, low, close. These are probably, and the volume, these are probably the most important things to me on that full quote. And I've already got it on the screen. So it's just a personal preference, but I'm not interested in using the full quotes. But for those that are interested in, I think it's fine. Especially if I was more of an income investor, I would definitely want to keep that dividend yield on there. But I think with everything else, I'm okay with the way my charts are set up.
We got a pretty simple one. It's actually really quick. So Loanne asked, where can you find the companies under Dow Jones Group like DJUSSC, so like semiconductors?
Okay. Well, one thing you can do is if you go into your dashboard first, and then come over here to sector summary or index summary. I mean, I'll start with sector summary because I do this a lot, but I know that semiconductors, for instance, are under technology. So I'll go here. Here are semiconductors. This is the Dow Jones US Semiconductor Index, the $ DJUSSC. And if I click on semiconductors, it will bring up, in theory, the stocks that are in that index. Now, I've had some discussions with Julius DeKempenaar over at Stockcharts, who's now in charge of the data. And this is one of his pet projects over there right now, is trying to go through and make sure that companies, when you see an index, that the companies that are listed in that index are in fact in those different indices. So that's something I know they're working on, but in theory, this is how you'd be able to find it. And then just depending on what you're looking for, I mean, you could sort this by market cap. You could sort it by scooter, which gives you the better relative strength performers. Over here is small cap, mid cap, large cap, depending on, I mean, you can use the columns to put anything you want out there. But then you could kind of sort it to find maybe some of the stocks that you'd be most interested in. I think there might even be, no, I didn't see one here. Yeah, I mean, that's for this list anyway, that's your limitations. And so you could just pull it up and just scroll through and see. So if you wanted to know if NVIDIA, obviously we know NVIDIA is included, but if you wanted to, you could pull up symbol and then you could just scroll down to see if you can find there's NVIDIA. So NVIDIA is part of it. Not sure how much more I can give you on that.
That's perfect. Yeah. Next one, we have a volume question involving the industry groups. Where does the volume come from on these Dow Jones indexes?
All right. Well, again, let's pull up the Dow Jones US Semiconductor Index. And got the full quote on here still. There we go. And so here's the volume down at the bottom. I've never reconciled it. I am assuming that the volume is going to be the total volume of all the companies that are in this index. But I know, like right now it's showing 48 billion for Friday. There are some companies that report, a lot of volume, and some could be in the billions. Especially some of the small ones. So I'm not positive. I've never really looked into it, but my guess is it would be I mean, what makes sense to me, it would be the volume of all the component stocks in that index.
And then we actually got a new member here, Scott. So he's got a couple questions for you.
Okay.
First one being a hollow candle question. What is a hollow candle?
All right. Well, let me see if I can find one for you. Let's do trying to think one that I just saw recently, but we'll just pull up NVIDIA. There should be plenty of hollow candles in here. Right down here is a hollow candle at the end of, or at the beginning of August at this bottom. Really what a hollow candle is, and I've taught courses and I could talk about this for 30 minutes, which I really don't want to do. But the key is that there is a rectangle that you can see is hollow. It's not filled in with any colors like the others. You can see some other big red ones there that are filled. Those that are hollow that don't have the filling means that you are closing above your open. So the bottom of the rectangle is the open. The top of the rectangle is the close. And then these little, what they call tails or shadows or wicks coming out each end represents the high of the day. The very top of that candle would be, or the top of the tail would be the high of the day. The bottom, the low of that candle would be the low of the day. But the body of the candlestick is simply it's engulfing from open to close. So if you see this outlined in red, what it's telling you is that you still closed below the prior day's close. So you closed down for the day. If you owned it, you lost money, but it's finished above the open. Now, if you see another one over here, like the one here on September, I guess that would be September 11th right here. This one is hollow, but it's bordered in black instead of in red. The only difference there is the black means that you open or that you closed and you actually made money that day. So your close that day was above the close from the prior day. But still same configuration, you're closing above the open. And here you can see there was no tail coming out of the top of this candle. That means that your close was also your high of the day. So you finished the end of the day right on the high of the day, which tends to be very, very bullish, generally speaking.
Murder.
All right.
All right. Moving on. Quickly, could you go over what you think the defensive sectors are?
Yeah, I mean, some are more defensive than others, just like the aggressive. I find, there are five aggressive groups, but technology, discretionary, and communication services are the three most aggressive. To me, there are four defensive groups. We got healthcare, we've got staples, real estate, and utilities. Healthcare to me is the least defensive. I mean, there are areas that are very defensive, like the pharmaceuticals. But I also see areas like biotechs as being very aggressive. Medical equipment, somewhat aggressive. And when I say that, these are companies that, when I think about aggressive, I think companies that can grow their earnings faster so that their multiples would expand faster, as opposed to companies who generally do about the same amount of business every year. So when you think of defensive stocks, a lot of times I think of companies that are selling us things that we need, like utilities. You can't really, first of all, there's not a whole lot of competition in utilities. You just pay whatever is charged, and that's based on, some of the local jurisdictions and so forth, and they set how much you're going to pay for your energy, and that's it. And they go through this, and there's normally not a whole lot of gyration from period to period in terms of how those utilities, that energy is calculated. Consumer staples to me is highly defensive. Companies that you look at and they're like Procter and Gamble and Johnson and Johnson and many of the drug companies. I mean, you got Pfizer and Merck and Lilly and all these companies. I mean, some grow earnings faster than others, but for the most part, when you're looking at staples companies, they're all selling us things that we need. And we're going to have to get those, whether we're having a bull market, a bear market, doesn't matter what kind of market. I mean, if you're buying soap, for instance, based on when the stock market goes up, then I don't want to be around you during a bear market. Because if you stop buying soap during a bear market, they can last for a couple years in some instances. So you're not going to be smelling very good after a couple years. But those are the things that the staples and defensive areas a lot of times are selling us things that we absolutely need to have. So bear market, bull market doesn't matter. You're going to get soap. You're going to get toothpaste. You're going to get those necessities that we have to have from day to day. So that's, when I'm looking at defensive sectors, that's what I'm thinking about. So, like I said, healthcare, staples, utilities, and real estate. And within those groups, I would say probably the most defensive would be utilities and staples because those are things we absolutely need. And generally, companies that are, these food product companies, for instance, that's a staple. You know, um, you just think about, Kellogg's or something like that. I mean, people are buying food all the time. You have to buy food. And so those companies don't tend to see their earnings go all over the place. They tend to see their earnings pretty steady in any kind of market environment. So when the market's bad and the economy is weak, defensive stocks tend to outperform. And when the economy is strong and you got technology companies exploding to the upside, that's when your defensive groups they may be growing earnings, but they're at a steady pace and they tend to underperform in a really good market. So hopefully that helps. And thanks,
Beautiful.
Scott, for the new membership. Appreciate that.
Yeah, absolutely. And still on Scott. If you pull up a stock like Duolingo,
Okay.
which is I think DUOL,
Yep.
yeah, you got it. Um, it was a stock that I think on Market Vision was above the 50 but under the 20.
hmm
Uh, how would you trade a stock like that?
Um, well, usually I like to trade uptrending stocks based on tests of the 20-day moving average. So when stocks are going up, like Duolingo was back in August, and you see this breakout on the PPO, you get that cross of the center line. This is now showing bullish momentum. First pullback normally will hit the 20-day and bounce. That's what I look for. So on a stock like this, you fall back to the 20-day. It's a great way to get into a stock with a fairly tight stop. If it, can't get through, or, if it doesn't hold the 20-day, you get right back out. And on a stock like this also, for me, trading is all about corroborating evidence. Here, you can see that there was some pretty significant resistance as we got up to about the 215 area or whatever this is. But based on the PPO, when it pulls back to the 20-day, one of two things can happen. Either we are starting a new uptrend and that 20-day holds and we explode to the upside, or we just, come up here to the prior resistance and fail and roll back over through the 20. When you go to the 20, you don't know which is which. So you have to make the decision. If you're gonna short a stock at resistance, then if it breaks out, you get out of it. And what you're looking for is for it to roll over and go below the 20-day moving average and continue the weakness that we've seen prior. But if you're bullish a stock like this, you want to buy it on the pullback to the 20-day. If it fails to hold it, you get out and then you move back to the upside. So that's the way I normally like to trade the 20-day. When price action continues to move up for a while, that's when you start to see, problems develop in the PPO where you're moving to new highs, but you don't have, you got new highs in price, but you don't have new highs in the PPO. And that's when you start to see more action between the moving averages where you drop below the 20. But first, you're still above the 50. I would, again, I'm not looking for, once I see negative divergences, I'm not really looking for the 20-day to hold. I'm more interested in the 50-day. Now, where we are right now on Duolingo is I see a couple of areas of support. So if I pulled this up, I would be looking like right about in here. This is kind of where you have multiple tops. We went through it. We held as support. That's down around 300. And if you notice, the low came in at 305 on Friday. So it's kind of testing that support area. The other support I would have been expecting to hold would have been this high when we broke out there. We came down, we tested it, we bounced, we tested a few times, and now we've moved back down. So I think this is your area of support. We're in it right now. I think if you fail to hold that, I think we've got a couple more areas. You've got this one, the next low, down at less than 280. You've got these highs over here that come in, 250. I mean, that's all it is. When you're going up, you stair step. When you come down, you stair step. So in order for me to feel more comfortable about this stock, I'd want to see this initial support area right in here hold 300 to 320 and move back up through the moving averages. If we don't and we fall through, then I think you got to keep looking to those further support levels down below. And quite honestly, I'm not really interested in trading on the long side if I see a stock that keeps breaking down below support level. So I think Duolingo here, just as an example for me, needs to hold on to this area of price support because it is below the moving averages. That's a bearish development. And if it can't hold its price support, things start to look more bearish.
Last question from Scott. What if you don't have stock charts? How else can you determine these shifts?
I use Stockcharts, so I guess you'd have to use another platform. There's
Yep.
plenty of platforms out there. I've used Stockcharts now for 20 years, maybe a little over 20 years. So it's, this is just what I use. And so the platform that we have at Earnings Beast is based off of this. But if you have other platforms that you use, we do have ways of downloading the symbols in our various chart lists and so forth so that you can load those over into another platform. I know Aaron does this. Matt, you probably have helped in that area as well. But if you do have issues like that, just write into support@earningsbeats.com and we'll try to help you there.
Absolutely. All right, moving on. We got a question from Vlad. He had a reversing candles question with divergences. So can you include reversing candles in discussions of divergences and how the relationship is established or
Yeah, that's a great question, and I don't know if I'll be able to come up with one right off the top of my head. But when I see negative divergences, first of all, and I've written about this a lot, you don't know, like when we first break out right here, if you notice this breakout above this top in mid-August, when we first make that breakout, if you look, the PPO would be below where it was before. When we first make the breakout, which would be, looks like on September 9th, let's zero in here. So right here on this candle, September 9th, we take out these highs. Look at where the PPO is. So we've now got a new high, but the PPO on that date is below the prior PPO. Technically, that's a negative divergence. Now, when you're first starting a move to the upside, when you get that first pullback to the 20-day and then break out, and many of the subsequent ones as well, when you first break out, you're initially going to have a negative divergence. So one of the things I always talk about is you need corroborating evidence. When you see a negative divergence, you don't know how high it's going to go and whether or not that divergence is going to be eliminated, which many of them are. But if it goes up and it hasn't eliminated that negative divergence, it's still on, you can still see it clearly. And then you get like a bearish engulfing candle, which is a reversing candle. That combination would probably be enough to send me to the sidelines if I own that stock. Because to me, that's just doubling the risk. One risk is from having a negative divergence, period. But the second one is getting a reversing candle with that negative divergence. That's a pretty strong 1-2 combination that would tell me to get out of a stock. I can always get back in later if I want, but many times that that coming out will send a stock back down to its 50-day moving average. So for instance, here, we didn't have a negative divergence, but had we had a negative divergence, when I saw that reversal right there, probably I would have gotten out of the stock and waited for perhaps a 50-day test. But again, momentum picked up and we were much stronger there. So that's just a short-term little pullback, which it did. The next day we had a lower low. That's all a reversing candle. To me, that's successful. You might look at it and say, well, that reversing candle didn't work. And I would say it absolutely worked. It gave you a reversing candle saying that prices were going to go down. Next day it went down. So reversing candles are great, but they're very, very short-term in nature unless we combine it with something that's a little bit longer term in nature, like a negative divergence. So I think having the two together definitely gives me more bearish vibes than just simply having a negative divergence.
All right. We got a question from Manny. He's an awesome regular of ours. Writes in pretty often. Very supportive. Um, so being that the Fed seems to be holding the cards, would you most agree, or what would you say the most important thing to watch for, especially in the first quarter, is inflation indicators, forecasting interest rate cuts? If so, what's the most important? Core CPI, PPI, PCPI, wage growth, unemployment, etc. What are your thoughts?
Well, as far as inflation goes, I think the two most important um, reports to watch for are the monthly core inflation report. So that would be the CPI that comes out monthly. And I would check that core rate. And then the other one the Fed has talked about is the PCE. So I think those two are probably the most important to keep an eye on. For me, it's the core inflation. I mean, I've gone back and looked at charts and so forth. I mean, I'll show you from let's see. Actually, let's use last year's market vision. And I think down here, here's the core inflation. So, I mean, this is where we stand right now, where we topped back in 2022. That's when we had the biggest problem going into 2022 and then throughout the first 9 months. And I said back then, once you get a top in inflation, the annual rate of inflation, when it tops, historically, when it tops and starts to come back down, the stock market usually explodes to the upside. And if you go back and you look in 2022, that was the bottom of the bear market. The cyclical bear market occurred almost simultaneously with the high in that annual inflation rate. Now it's coming back down. What the Fed is concerned about in the near term, and frankly, I think it's completely overblown, because they even mentioned that it was going to hesitate. It was not going to go straight to 2%, that they felt like it was going to be challenging for a period of time. This was back a couple months, 3 months ago, they talked about this. And so now we're actually seeing what they talked about and the fact that it is kind of flattening out. It's not really going straight down toward 2% anymore. But now the market is all of a sudden using that as reason that inflation is spiking and that inflation's bad and that rates, we're not going to get rate cuts. We're going to get rate hikes. I just don't believe any of that. And I'm looking at the chart that tells me that, yeah, we've gone sideways. Maybe we've kind of moved back up, what, 0.1%, or maybe 0.2% in the annual inflation rate. But again, that's what the Fed said they were looking for a few months ago. And now all of a sudden seems to be a big problem, which I don't really understand. But for me, the biggest inflation news to me is on the price charts of looking at growth stocks versus value stocks, looking at the hedges to inflation, gold, real estate. I mean, if Wall Street's truly concerned about this, it's going to show up on those charts. I don't need to wait for the CPI report. You know, when the Fed came out this past meeting and said that they were going to go from 4 rate cuts to 2 rate cuts, and that their target rate wouldn't be hit maybe until 2027, the reaction in the news has been, oh, inflation's a big problem again. Got to be careful. Interest rates are going up. Well, interest rates go up for a couple of different reasons. I'm not so sure rates aren't going up because the economy remains so resilient and strong. Jobs just showed us that. I don't know that that's an inflationary problem. So I look at growth versus value. I look at the hedges, and I look for Wall Street to tell me if they're rotating. Wall Street's not going to be taken by surprise. If you go back and you look in 2021, money was rotating long before we got to these peaks in inflation. The end of 2021, money was rotating. Wall Street was already moving into other areas. So I think you got to follow the charts more than anything else. And the charts right now are telling me, don't worry about inflation. So yes, the market's been weak. Yes, we're rolling over. We're seeing some breakdowns potentially on daily charts. But I would just tell everyone, keep an eye on those long-term charts because they're still pointing higher. They are still completely intact. They're still bullish. And I think all of this discussion and talk about inflation, while it may impact the market short term, I can't tell you. I wish I knew. But as long as the headlines remain somewhat negative, we're going to continue to see these types of reactions. But again, Wall Street, in my opinion, is using retail traders' knee-jerk reactions, getting out of some of these stocks. And I think Wall Street's accumulating, meaning that eventually we're going to turn right back up. So I can't tell you what's going to happen in January, what's going to happen in the first quarter, or even what inflation reports you want to watch. But for me, when I think about inflation, I'm trying to follow what Wall Street is doing. And I'm just not seeing the fear about inflation in the charts that the media is trying to tell us, you know, that we should be feeling. So anyway, I hope that helps.
Absolutely. So we got a handful of questions from our guy Larry.
Okay.
How do you use the RSI line versus the PPO line?
Well, they're both momentum oscillators. They're just different. The way they're calculated is different. So here on this chart, I mean, I can see, you know, negative action here on the PPO. PPO, though, swings back and forth. It goes above the center line, below the center line. We've seen this back and forth on the S&P 500. We've seen 3 crosses to the downside. The first one was in April. We saw a pullback, I don't know, maybe less than 10%. Then we got July where we pulled back closer to 10%. I think maybe we hit just right at 10%. And now we're in this one. We don't know where we're going to go. We were at 6,100. 10% would take us back to about 5,500. So right now the momentum is bearish according to the PPO. When you look at the RSI, again, it's calculated differently. Normally during uptrends, what I look for is support around 40. We are at 39.14 right now. So we're just below that 40 level where a lot of times we'll bounce. I mean, if you go back and you look, this one, we got down to almost 40, hit the 50-day, and we bounced. And that bottom we haven't seen since. This one right here, the RSI got down to 40. We bounced, never went back down there. This one was a little bit deeper for longer, and we got all the way down to 30. Same with the one in April. But my thing is, you know, here we got down to 40, here we got down to 40, and now we're back at 39. So we've essentially had 3 bottoms here, and all of them have occurred with the RSI around 40. If we start out next week weaker, then it's going to start looking like we're probably going to see a bit more weakness in January than what I was anticipating. But again, with the, you know, a lot of the media, a lot of the headline news, and so forth, it's, market's going to go up and down. I can't possibly control that or tell you exactly when it's going to go up or down. What I can do is look at the market and tell you whether or not I think that this is truly a big breakdown that we need to worry about, or if it's something that I think will be fairly short-lived. And based on what I'm seeing, I think it's fairly short-lived. And I think, again, the PPO, RSI, they're both momentum oscillators, but they tell us a couple of different things. And I'm still bullish the market, even though both of them, RSI below 40 and the PPO below the center line, they're giving us warning signs on the daily charts. But if you out to the weekly chart, look at the same signals. So here you can see the PPO, weekly PPO is well above zero. And you can see the weekly RSI right now is at 53. So they're both fine. So again, it's just a short-term breakdown whether or not that is going to morph into something really bad down the road. And for me, I don't think it is.
Gotcha. All right. So I think this is a copper relative to gold question. When you see the relative chart of that, if it reverses, do you think copper will outperform gold? What do you think about uranium? How big is the upside in copper, etc.?
Well, I don't really follow uranium, so I'll just leave that at that.
Throw that out there.
Yeah, just throw that one right on out there. Copper versus gold. Normally, copper is an industrial metal that is used a lot. When global economies are picking up, there's a lot more demand for copper, not so much gold. I don't know, gold is not really used much in industrial, in global economies. When the economy's picking up, gold isn't purchased when the economy strengthens. Usually gold's purchased when the economy weakens, global economy weakens. So by looking at these two relative to one another, it gives you a good idea of whether or not, kind of where we are globally. Um, Not necessarily on the S&P 500. I mean, I like to use the S&P 500 and this ratio kind of as a sustainability ratio, but it's still limited. One thing it's limited by is that the S&P 500, it is a multinational index, but if the demand is not great overseas and in various parts of the world, copper is going to have some problems. You know, the US demand and the US economy by itself is not going to drive gold higher. So the question is, like, if, this starts to reverse, which it has over, so far, first handful of days in 2025. So if this does continue to reverse and move higher, then yeah, I'm going to think pretty bullishly about not only the S&P 500, but possibly international markets as well, because that's telling me that there's less demand for gold relative to copper. So it's like the focus of global indices now is shifting more towards the economy being stronger. And as we see rates being lowered around the globe, that's what I would expect. So I think this is probably something we should keep an eye on in 2025. I believe if we do continue moving higher, that's going to be one of those sustainability ratios that I believe is going to be pointing toward higher S&P 500 prices and maybe higher international equity prices, more so than what we've seen probably over the last 10 to 12 years.
Right. So if correct about the IWM and not a big trader, does it make sense to take an oversized position in IWM or something like that, uh, and have a smaller percent that you trade in the smaller caps? I mean, IWM follows the small caps,
Yeah.
but yeah, we
All
might
right.
just skip that one, or if you want to go for it.
Well, go for it. I mean, IWM, I mean, I'm in favor of small caps, but when they're underperforming like they are right now, you're much better off in the IWM than you are in individual small cap stocks for the most part. Because the individual stocks, especially some of the stocks that were leading the IWM back in second half of 2024, are rolling back over. You have to understand the IWM is extremely diversified. There are 2,000 companies that are all weighted about the same. So to me, when the IWM is going higher, if you can spot the leaders, I think you can do way better with individual stocks than you can with the IWM, individual small cap stocks. So that's my goal. If I think the IWM is turning higher, I'm going to be in more individual stocks. I'll be in the IWM. I might be in the TNA, which is a leveraged ETF that tracks the IWM 3-to-1 ratio. So if the IWM goes up 5%, TNA would go up 15%, and the other way around as well. So if the IWM goes down 5%, TNA would go down 15%. So when the IWM is hot, when it's trending up, when it's outperforming, that's when I'm generally going to be more aggressive with either individual stocks or with that leveraged product. When, like where we are right now, I mean, we're clearly in a downtrend on an absolute chart and on a relative chart. So right now, the majority of what I have in small caps is in the IWM, and that's just it. So I'm sitting mostly with that. I've got a few individual stocks, but until things turn, and I think they're going to turn, but I think it's really pointless to try to enforce your will on the stock market. The stock market's going to do what it wants to do, and you can sit there and be as adamant as you want. I mean, there is a such thing as being stubborn. And if you're too stubborn and you say, oh, well, it's going up, I'm just going to put everything in the TNA, it's been really painful for the last month if that's been the strategy, which is why I think that's crazy to have that kind of strategy. And anytime you trade the TNA, make sure you have stop losses. Any leveraged ETF, make sure you have a stop loss point in mind, where if it goes below that, you just get out. You can't take a chance on tripling your losses during a downtrend. That could ruin you. So anyway, yeah, I think, when you get to a point where the IWM is performing well and small caps are doing well, I think small cap stocks, if you're following technical analysis and you're following the leaders, I think you're going to find there to be some tremendous opportunities in some small cap stocks that could go up 5, 10 times in a year, as opposed to the index, which could have a great year and might go up 50% or even 75 or possibly even 100% in a year and a half. But individual stocks could go up a lot more than that. So that's my strategy. But if you wanted to keep it closer to the vest, be a little bit more conservative, then I think the IWM makes sense.
So we got a question from Morgan. Will your weekly schedule remain the same through the year? Are you planning on making any changes?
I'm not sure if that's like like the shows I'm doing and stuff like that. I
Yeah,
mean,
yeah,
yeah, I pretty much have the same schedule in place I've had the last 5 years. I mean, we've added a product here or there. We maybe have changed our schedule a little bit in terms of shows. I think the shows are pretty good kind of as is right now. I've been thinking about maybe doing some more, but that just takes away from some of the other things that we do at Earnings Beats. And quite honestly, I mean, if we're doing a Tuesday show in the morning, we do a Thursday show that's over at Stockcharts, and then I do a Saturday show, which is kind of a weekly recap. I mean, that's three. And between those three shows, probably is about an hour and 15 minutes of airtime, in addition to all the reports we do and so forth. So I'm not looking to change our schedule at all. I think our schedule is pretty good, but anytime you have suggestions or something that interests you, we sent out a survey recently. If you didn't fill out the survey, you probably can still go back and fill that out, I'm assuming. Maybe not. We may have shut it down. But, those are the ways you can kind of get some of your opinions expressed if there's something that maybe you don't think we're spending enough time on. But as far as we're concerned, our schedule will be relatively the same.
So this is a Market 2025 question or Market Vision 2025 question. So I noticed that Dave does not use logarithmic scale and Tom does. Any comment or perspective would be appreciated.
All right. Well, here, let me just show you the S&P 500. And let's go back. Let's go back 50 years. And we'll do a weekly chart. And let me put this, I've got mine on a logarithmic scale, but let's get rid of that. So this is what that chart would look like. Now, how can you tell what's going on back in the 1970s or 1980s? And doesn't this look like it's parabolic? Like we were going up at a steady pace, and then all of a sudden we've just turned parabolic. I see a lot of folks who use arithmetic charts like this and try to claim that we're in a, this is a parabolic move to the upside and we're going to have a crash. Well, a couple things. Number one, notice that the distance between these lines, 500 to 1,000, which would be a doubling. When you go from 500 to 1,000, you would have a double on the S&P 500. Here you go 5,500 to 6,000. That would be a 10% increase. A 10% increase now is showing up the same as a 100% increase was back, in the 90s. I mean, it just doesn't make any sense. I don't understand why anybody would ever use an arithmetic chart. I mean, that's just my personal opinion, and I, debate it until, as time goes on. Now look at a logarithmic chart, which shows the distance. Look at the distance between 125 and 500. That's 4 times. Do you see how far apart that is to go up 4 times? Well, to go from 500 to 2,000, look at how far apart that is. It's the exact same distance. So it's taking into account percentage moves rather than point moves. This, to me, is much, much more comparable. And now does it look like we're in a parabolic move? I mean, it looks to me like we're in a channel. I mean, I don't know if we draw these lines however you want, but, if you wanted to draw it there and then drag that up in here, I mean, connect these highs. I mean, this, for the most part, encompasses everything within this channel on the S&P 500 except the dot-com bubble, which went outside the channel. So I look at this and I'm like, yeah, we've had a nice run and we're now at the upper end of the channel, but to me, this doesn't look nearly as bad as, it certainly doesn't look like a bubble to me. It doesn't look nearly as bad as going back and looking at this arithmetic chart and looking like we're just going straight up. So to me, that's the difference. I think logarithmic scales are way, way, way better than arithmetic. And honestly, if you see me post an arithmetic chart, write in and ask if I'm doing okay, because that just doesn't make any common sense to me, and you're not going to see me using them.
It's funny. Gotcha. We'll definitely we'll send out a search party for you. If you ever use arithmetic. That's awesome. So next we have a question from Steven. What's your preference over, blah, 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 excuse me, preference for EMA over SMA in all cases is his question.
Just personal preference. I talk about this every once in a while. I get the question all the time. But I've got the 20-day EMA. If you look over here, 20-day EMA, 50-day SMA. MA is just simple moving average. EMA is exponential. Or you go down into the bottom and you can see I've set up my overlays. Simple moving average for 50, exponential moving average for 20. So why do I do that? Well, I don't know. Maybe I'm a little crazy. But I'd like to think that it makes some common sense. I don't think it matters. I think if you use simple for the 20 and the 50, or if you use exponential for the 20 and the 50, or if you're, using both with the 20 and the 50, I don't think it really matters that much. The reason I do it this way is that for me, the 20-day or 20 period moving average is a short-term moving average. And so I'm using that kind of as my trading trigger. And it makes sense as a short-term trader to use maybe some of the more recent data within the 20-day moving average. The more recent data kind of makes sense to have more weight on it. If you take a long-term moving average, so you're trying to see how things compare to the long term, why do you want to zero in on the most recent data on a long-term moving average and weight it? Same thing with the 200-day. I don't understand. To me, it just doesn't make any common sense. So I just like to use simple moving averages generally. But if I'm going to look at a short-term moving average, then the EMA is going to give me a little bit more a little bit more, what's the word I'm looking for? Weight, a little bit more of a bias, I guess, towards the more recent data. And I just find that to be more useful from a short-term momentum perspective than from a long-term perspective. So I've just always done it. I've never changed it. I mean, I guess if I was going to change it, I don't know. I don't even know if it would matter to me whether it was the EMA or the SMA that you would use. But that's, really a personal choice. But that's why I do it the way I do it.
We're almost getting there, Tommy. And we got a couple more left.
All right.
So we got a couple charting questions from Todd. How do we set up the relative strength performance overlay in the industry groups on stock charts? Or sorry, on a stock. So like below your chart, essentially.
Yeah. So let's say NVIDIA. And so we know NVIDIA, well, I know most everyone probably knows, but if you don't know, NVIDIA is part of the semiconductor group. So the question is, okay, if I have NVIDIA, one thing I could do is I could go down here under indicators and I could put price in, and I could just put in NVIDIA versus the Dow Jones US Semiconductor Index and make it the height 1.0. And I usually do solid lines instead of candlesticks. So, and then this shows me down here now how NVIDIA trades relative to semiconductors. But that assumes that I know that NVIDIA is part of the semiconductor group. So there's a way you can set it up on stock charts if you don't know, or if you just want to set this up as like your default chart, so that anytime you look at a stock, you also will have the relative strength on here. Here's what you can do. So I'm going to look at the price. But in this case, what I'm going to do is I'm going to bring up dollar sign, symbol, colon, and it's given me the answer there. So I'll just click on it, colon, dollar industry. And so if you put that on your chart, and let's see, we'll do height 1.0 on the RSI. Anyway, so if we do this on the chart, and we can even make this bigger so that it's easier to read, 1500. Hold on one second. Now, if I'm looking at NVIDIA now on this chart, now I've got, the obviously bigger, bigger viewing area. But here it comes up NVIDIA versus semiconductors. I didn't type any of that in. Stockcharts reads it just for me putting in the price, dollar symbol, colon, dollar industry. And so that's, how you do it. Now, if I change the price here, or if I change the stock, and let's say I want to look at Microsoft. When I look at Microsoft, it will automatically change Microsoft to the software index. Now, if I had typed it in NVIDIA versus semiconductors, I'm pretty sure this would have come up Microsoft relative to the semiconductors down here. But because I have symbol colon industry, that makes it a little bit easier so that you don't have to make that change every time. So hopefully that will help. And then if you wanted to set this up as one of these style buttons, see how I've got these style buttons over here? You could call this, you could just say my relative strength. And I could add new. And now all of a sudden over here, this is my relative strength button. And so I could be looking at, let's see, applied materials. So I could be looking at applied materials over here, and then all of a sudden it's like, no, I want to see the relative strength. I can just click on that my relative strength button, and applied materials will come up and show this. It's pretty cool. And you can see applied materials has not been a very good performer relative to the semiconductor. So probably one that maybe you would want to look elsewhere in terms of at least short-term momentum, because it isn't a very good relative performer. Hopefully that helps.
I think it will. Another one from Todd. Regarding the IWM and the 10-year treasury, do you ever look at the 10-year treasury historical seasonality for an individual month? I know you said that seasonality is important, and you emphasize the 10 years important on the IWM's performance.
Good question. I mean, I don't use seasonality for everything. I mean, the 10-year treasury yield, a lot of times I use seasonality, or I depend on seasonality when I believe that there's a common sense fundamental reason why that seasonality would work. Gosh, I could go on and talk about this for a long time. Let me try to make it somewhat short. So if I'm looking at the IWF, which is large cap growth, versus the IWD, which is large cap value, and I go back and I drag this back 20 years, one of the things I'm going to find is that the third month of each quarter, if you add them up, so for instance, IWF 0.3 in March, 1 in June, so now we're up to 1.3, minus 0.3, so now I'm at 1, and then minus 0.5. So in the third calendar month of each quarter, March, June, September, and December, IWF outperforms IWD by 0.5%. That's it. But if we look at, say, I don't know, let's do the first month. 0.7 minus 1 minus 0.1 is 0.6. Plus 0.6 is 1.2. Plus 0.3 is 1.5. So now in the first month of each calendar quarter, the IWF outperforms the IWD 3 times. Instead of 0.05, it's or 0.5, it's 1.5. And if we look at February, 0.7 and 0.8 in May, it's 1.5. August, 0.9, that's 2.4. November is 0.2, that's 2.6. That's 5 times growth over value. So if I know that over the last 20 years, then I'm going to be interested in stocks from a seasonal standpoint that might do very well during the 2nd, 5th, 8th, and 11th months. So that's the second month of each calendar quarter. So I pulled up NVIDIA, and let's pull this, we'll go back 20 years. But look at February, May, August, November. Now, this is an extreme case, but I know NVIDIA loves these 4 months. And large cap growth outperformed during these months. So when I look at NVIDIA's seasonality, I already have reason to believe that the second month of each quarter could favor growth stocks. And then I get a major growth stock that shows this behavior. And seasonality means a lot to me when I'm looking at this. Now, if I just go back and look at the 10-year treasury yield, and I pull that back 20 years, what am I looking for? I mean, I don't know. Rates go up and they go down. I don't really know. There's nothing that makes sense to me that tells me that I would want to go in. I mean, the only thing I can think of is that maybe in the summer months, I know from mid July to mid September, that's the worst time for the stock market. So if I was thinking anything from a common sense perspective, I might think 10-year treasury yield, money's going to rotate out of bonds and into stocks. Or excuse me, the other way around, out of stocks and into bonds, right? During those 3 months, because the stock market doesn't do well. So that hopefully would lead to money going into bonds, which would then send the yield lower. Well, if you look at July and August, the yield over the last 20 years has gone down because money normally rotates in the summer months because of the historical stock market weakness. So that is probably the only thing that really makes a lot of sense to me. And then the 10-year treasury yield going up in the fourth quarter kind of makes sense, because for the yield to go up, that means bond prices are going down. If you're selling bonds, that money could go over into the stock market. Well, we know the fourth quarter is the best time of the year for stocks. So that relationship kind of makes sense, that maybe yields I would expect to go up in the fourth quarter, and that maybe I'd expect yields to go down in the summer. But for the rest of the time, I'm not sure. And most of the rest of the year is kind of flat. So I don't really know what I'm looking for other than what I just pointed out in terms of what I would expect historically. or even if there, I mean, I'm just not seeing any other sign, any other signal from a seasonal standpoint. I don't know if that makes sense, but to me, seasonality makes more sense if I know kind of what I'm looking for. Um, like I would expect maybe consumer staples to do better when I know growth is going to do better in the 4 quarters in the third month of the fourth quarter, or excuse me, the third month of every quarter, March, June, September, and December. That's when I said that growth doesn't do as well versus value. So when I look at something like utilities or staples, let me do staples, and I look at the S&P 500, I might expect a little bit more out of the third, sixth, ninth, and 12 months of the year. Here's the third. Well, this is only 5. Let's go back 20 years. So there's the third month. Staples outperforms by 0.7. The sixth month, it outperforms 0.2. The ninth month, it outperforms 0.4 or 0.5. And the 12th month, it outperforms 0.1. So again, based on the way I know the stock market operates, I could start to look for certain things, and it kind of proves correct that this, on a relative basis, Staples does the best during those months. Didn't work in December this year, by the way. If we just drag this all the way back, just show 1 year, well, we'd have to go back here. We underperformed in December 2.3%. And if you look at the end of the year, do you see money rotating towards staples? Do you see money going toward defensive areas of the market relative to the S&P? I mean, how about real estate? Got a big, big inflation. Everybody's worried about inflation. So that should mean that real estate's doing really well. On 2024, fourth quarter, real estate was getting killed on a relative basis. So, I mean, there's so many ways to use seasonality. I could go on and on. We could make this a show in itself. I think I'm trying to already. So let's just leave it at that. But no, I mean, I'm not really seeing, I don't really use the TNA or the TNX, the 10-year treasury yield. I don't really focus in on seasonality other than what I would say is maybe the summer months and the fourth quarter.
In classic fashion, we'll end with the macro question. Uh, this one is from Tim. Tom, did you say you expect the end of this decade will be the end of the secular bull market?
I believe that the bull market has got a lot of time still to run. And just a very quick reminder, I show this in the weekly market report every single week, but here's my long-term S&P 500 chart. And if you go back and you study it, when we get breakouts, some key breakouts to start a secular bull market, here 1950 to 1970, basically we're in a secular bull market for 20 years. When we broke out in 1980, that started a secular bull market that lasted 20 years. So when you break the highs of the bear market, the secular bear market, when you break those highs in April 2013 and you add 20 years, what do you get? I get 2033. We're just starting 2025. So I believe, based on history, I think these cycles have been pretty. I mean, if you look at the two secular bear markets, they look pretty similar. They last both about 12, 13 years. So based on that, I mean, I would just estimate, it's just an estimate, but yeah, I think this secular bull market will go on to the rest of this decade and into the next decade. And as we get into 2032, 2033, if we are still going up, based on this chart, I would start to get a little bit nervous and start watching perhaps for a potential bear market. And the thing is, you're probably not going to realize, if you get to the end of the 1990s, who was thinking bear market back then? If you were investing, my gosh, we were going straight up. We thought everything was going to the moon at the end of the 1990s. So nobody's going to send you a flyer and tell you that the bull market's ended. You're going to have to just kind of use some common sense, use perspective, but I could see in another 7 or 8 years getting to a point where we're going to be in trouble in terms of US stocks for a long period of time, probably another dozen years or so, which could take us all the way up to 2045. And I hope I'm still coherent enough to talk about it when we get there. But that's just from a long-term perspective and how the market has evolved over time. That's kind of what I'm expecting. And I think it's kind of makes sense. You go through cycles in the market where you go from a very beaten down stage where stocks are so undervalued that you need to start moving up again just so we can play catch up. And it just so happens that we tend to play catch up over 2 decades. So, yeah, I think we still got room left. So, was that the last question?
I believe so.
Wow. Okay. So, this is
So,
a much, much longer Q&A session, but I appreciate it, Matt. Thank you.
absolutely happy to help. And we'll just send out some time-stamped stuff of the recording to all the people that asked questions, and you'll get that from support. So post this
Sounds
on
good.
YouTube too for anyone to watch as well.
Yep. The timestamp will help everybody kind of zero in on any questions you have, hopefully. But yeah, appreciate all the questions. Appreciate everybody who attended Market Vision 2025. I think it's our biggest event, obviously, for good reason. And tried to get to your questions. Hopefully what we went through answered everybody's questions, or at least got them partially answered. If you feel like there's still some others out there that, you just can't quite come to grips with, send us a message to support@earningsbeats.com, and we'll try to cover that next week on the next Q&A session. So thanks again to everybody. Thanks, Matt, for being here, asking the questions, and thanks to Tyler for all of his behind the scenes work on the video. Everybody take care, and we'll see you in the Q&A next week. Happy trading.